Here's a brutal truth that will save you from financial ruin. If you buy your first size at the peak, someone smarter just sold to you. Every bull market ends the same way professionals distribute to amateurs while headlines scream, "New paradigm." This isn't market manipulation or conspiracy theory. This is mathematical certainty playing out through human psychology. The tape slows. Leaders falter. Good news fails. Then the floor opens beneath those who refuse to read the signs. Picture this scenario that plays out in every cycle with clockwork precision. A trader sees his tech darling gap up 7% on record earnings that beat estimates by 12 cents. His heart races. This is validation of his thesis, proof of his stock-picking genius. He chases with his largest position size yet, convinced this breakout confirms the next leg higher. By market close, the stock sits red on volume 3 times the daily average. He calls it market maker games and posts about diamond hands. Meanwhile, a professional sees the exact same price bar and sells a third of his position without emotion or commentary. The amateur sees confirmation. The professional sees distribution. Next week, the stock makes a marginal new high on breadth that's noticeably thinner than the previous advance. Fewer stocks participate in the rally. Volume remains below the selling climax from the prior week. The professional sells another third into this strength. The amateur, vindicated by the new high, adds to his position and tweets about weak hands getting shaken out. 2 weeks later, a break through the pivotal point, that critical support level that held during the entire advance, erases 2 months of gains in exactly 2 trading sessions. The professional sits with cash and a small remaining position. The amateur holds a full position underwater, wondering what went wrong. This is the identity contrast you must accept. Amateurs buy price, professionals buy character. When the market's character turns, fewer stocks making new highs despite indices pushing higher. More down volume appearing on supposedly up days, professionals lighten up into strength. They don't debate market maker manipulation or Federal Reserve conspiracy theories. They simply distribute their inventory to willing buyers at favorable prices. Price is loud, character is quiet, and quiet signals are where serious money hides. Your protocol begins now with religious tracking of distribution days. Mark every session where major indices decline on above average volume. This represents institutional selling, overwhelming retail buying. 3 to 5 heavy volume down sessions within 2 weeks signals character change from accumulation to distribution. Layer on the climax run test, a 20% to 30% sprint in 10 to 20 sessions from already extended levels. That acceleration looks bullish to the crowd but represents forced buying, benchmarks chasing benchmarks, FOMO chasing FOMO. Professionals sell into that strength because risk becomes asymmetric. Little upside, air below. Watch for the moment when good news stops producing new highs. This represents the market's most reliable tell that distribution is accelerating. When positive earnings surprises, favorable economic data, or bullish analyst upgrades fail to lift prices, the tape speaks louder than headlines. Professional traders listen to price action over narratives because price reflects collective actions of all participants, while narratives reflect hopes and fears of commentators. The distribution process follows predictable patterns Jesse Livermore identified nearly a century ago. First comes the climax run, vertical advance compressed into sessions that exhaust available buyers. Smart money recognizes this mathematical reality and begins systematic selling. Markets need constant flow of new buyers to sustain advances, and climax runs indicate that flow reaches exhaustion. When everyone who wants to buy has already bought, selling pressure naturally overwhelms demand. Here's the counterintuitive part most refuse to accept. The smartest trade near tops is often doing nothing. Cash is a position, and patience has positive expectancy when character degrades. Livermore called it waiting for the line of least resistance, and that line becomes invisible until time passes. Your job is preparation, not prediction. Preparation looks like trimming exposure, tightening stops, and rehearsing exits while everyone else celebrates. At tops, strength is for selling, not buying. This maxim contradicts every instinct developed during bull market advances, but it separates wealth preservation from wealth destruction. The market rewards contrarian thinking at inflection points, and tops represent the ultimate inflection, where yesterday's winning strategy becomes tomorrow's losing strategy. Bull markets don't end with dramatic crashes, they end with subtle shifts in character that most traders miss until it's too late. Write this plainly in your journal. At tops, I sell into strength, reduce size, and refuse late ads. Sign it with today's date, because commitments without timestamps are wishes. The crowd will mock your caution, just as they mocked every cautious trader in 1929, 2000, and 2021. The tape, however, never mocks it, simply tallies who managed risk and who donated capital. But distribution is just the surface layer of market tops. The real danger lies in how this process unfolds through time, and why most traders are either too early or too late to act on the signals the market provides. Understanding timing separates survival from catastrophe. Most traders are directionally right but temporally wrong. They refuse to be on time. Jesse Livermore called this the time element. Price is only half the signal. Time completes it. Understanding this distinction separates professionals from amateurs more than any other concept in trading. Tops are processes, not single prints. Your advantage lies in patience, not prediction. The market will teach you direction for free, but timing costs tuition until you learn to wait for complete signals. Consider what happened to a hedge fund manager in March 2000. For 3 consecutive years, he'd averaged 40% annual returns buying technology stocks during their relentless advance. His confidence reached dangerous levels. Success breeds conviction, and conviction breeds impatience. When the Nasdaq began showing clear distribution signs, he recognized the pattern immediately. He saw the climax run 18% in exactly 14 sessions, and his analytical mind screamed, "Top." Without waiting for confirmation, he immediately went short with significant size. He was absolutely right about direction, catastrophically wrong about timing. The market squeezed another 6% higher in 5 brutal days, stopping him out twice before the real collapse began weeks later. His mistake wasn't analytical, he read distribution correctly. His mistake was temporal, he acted before time confirmed what price suggested. Early is identical to wrong when managing capital. The market extracted maximum pain by rewarding his correct analysis with incorrect timing, a combination that destroys even brilliant traders who refuse to wait for complete signals. A professional would have marked the time element differently. After identifying the climax run, he'd draw the pivotal point, the last significant swing high before the climax advance, and the first meaningful swing low after. These become reference points for measuring time-based confirmation. Then comes the waiting, not hoping, not predicting, but systematic observation of how price interacts with time at critical levels. He waits for confirmation, a break of the 50-day moving average on above-average volume, followed by a rally attempt that fails within 3 to 7 sessions at a demonstrably lower high. Only then does he act with size. Only then does probability favor his position. This approach seems counterintuitive because it requires sitting still at the most emotionally charged moments. While amateurs chase every breakout and breakdown, professionals let time filter the noise from the signal. They understand that after euphoric advances, the tape needs 2 to 4 weeks to reveal its true intentions. Forced moves create temporary conditions that reverse quickly. Sustainable moves develop over time through consistent volume patterns and repeated tests of key levels. The time element operates on mathematical principles most traders ignore. Markets move in waves, and waves require time to develop, mature, and resolve. Climax runs represent compressed time. Too much movement in too little time creates unstable conditions that must revert. But reversion doesn't happen instantly. The market needs time to absorb the excess, redistribute positions, and establish new equilibrium levels. Here's your protocol for the time element. After identifying distribution through climax runs and character deterioration, require 3 specific confirmations before acting. First, a break of either the 10-week or 50-day moving average on volume that exceeds recent averages by at least 50%. This represents institutional selling overwhelming retail buying. Second, a failed rally within 1 week that makes a lower high than the breakdown point. This confirms buying pressure cannot overcome selling pressure, even at reduced prices. Third, good news that cannot reclaim the breakdown level within the rally attempt. This proves fundamental catalysts have lost their power to lift prices. This confirmation process demands patience, often 2 to 4 weeks from initial distribution signals to actionable entries. During this waiting period, amateurs grow impatient and act prematurely. They see the same signals but refuse to let time validate what price suggests. They want instant gratification from correct analysis, but markets don't operate on human timeframes. Markets operate on supply and demand cycles that require time to complete. Time teaches patience, and patience teaches timing. Livermore discovered his biggest losses came from being too early, not too wrong. Being early feels smart, you see what others miss. You act on superior analysis. You position ahead of the crowd. But early positions face maximum drawdown before eventual profit, assuming your analysis proves correct. Maximum drawdown destroys capital and confidence, making it impossible to hold positions long enough for profits to develop. The psychological challenge lies in sitting still while others act. When distribution begins, financial media increases coverage. Retail traders increase activity, and social media increases noise. Everyone has opinions about what happens next. Professionals ignore the noise and watch the tape. They mark time intervals, measure volume patterns, and wait for mathematical confirmation rather than emotional validation. Cash is a position during these periods. Waiting as a position often produces the highest expectancy trade, particularly at market extremes. Trying to force trades before the time element completes is like harvesting crops before they ripen. You only get inferior results. This deliberate pause allows for higher conviction and tighter risk parameters when eventual entries are made. Price tells you what, time tells you when. Combine both, or pay tuition. The market rewards patience at inflection points because patience allows complete signal development. Incomplete signals produce incomplete results, sometimes profitable, often painful, always stressful. Respect the clock more than your conviction. The time element reveals distribution through systematic observation, but there's a psychological trap that ensnares even those who recognize technical signals and wait for proper confirmation. Success itself becomes the enemy when traders grow overconfident in their ability to time market turns. The first psychological warning sign appears when success becomes your worst enemy. Jesse Livermore called this the confidence trap, and it's claiming victims in today's market with the same mathematical precision it demonstrated in his era. This trap operates through human psychology, not market mechanics. After extended winning streaks, the brain rewires itself to expect continued success. Losses become temporary anomalies rather than inevitable realities. Risk management transforms from sacred discipline into flexible suggestion. The amateur thinks, I've been right for 18 months straight, my edge is proven. This is precisely when maximum caution is required. Yet human nature demands the opposite response. Here's the mechanism that destroys even brilliant traders. After months of profitable trades, position sizes creep higher without conscious decision. What began as disciplined, 1% risk per trade, gradually morphs into 3%, then 5%, sometimes reaching dangerous 10% levels. Stop losses that once sat tight under pivotal points get widened to avoid noise. Pyramiding rules get bent for special situations. The amateur confuses bull market tailwinds with personal skill, sizing up when he should size down. Meanwhile, professionals treat extended success like borrowed money that must be repaid with interest. Watch this destructive pattern through a real case study. A growth specialist averaged 35% annual returns for 3 consecutive years buying technology leaders during their relentless advance. His fund exploded from $50 million to $800 million under management, attracting institutional money and financial media coverage. Success bred dangerous assumptions about market permanence. He began leveraging positions beyond original parameters, convinced this bull market represented permanent economic shift. When distribution signals appeared 3 heavy volume down days in 2 weeks, leaders reversing on climax volume, he dismissed them as rotation noise. This is just healthy correction, he rationalized, adding, to positions as they broke through pivotal support levels. His 3-year track record had taught him that buying dips worked, So he applied that lesson without considering changed market character. He increased position sizes from 2% risk to 8% risk per trade, believing his proven edge justified larger bets. When his core holding gap down 12% on earnings miss, it represented $64 million loss instead of the $16 million it would have been at original sizing. Within 6 months, he'd lost 90% of assets under management. Success became the vehicle for his destruction. The mathematics are unforgiving and often invisible until too late. A trader managing $100,000 who risks 2% per position loses $2,000 on wrong trades. If success grows the account to $500,000 and position sizing remains at 2%, wrong trades now cost $10,000. The absolute risk has quintupled while analytical edge remains constant. Larger absolute losses destroy confidence faster than smaller accounts can rebuild it. Success creates bigger targets for inevitable market reversals to attack. Professional traders recognize this trap immediately and implement counterintuitive protocols. As profits accumulate, position sizes must decrease, not increase. Risk management becomes stricter, not more relaxed. This seems backwards to amateurs who believe success earns the right to bigger bets. But professionals understand that extended bull markets increase, rather than decrease, systemic risk. Each new high brings the market closer to its inevitable reversal point. Your protocol for managing success starts immediately. Reduce individual position sizes by 25–50% after doubling account value through trading profits. If you typically risk 100 basis points per trade, cut that to 50 to 75 basis points during late cycle conditions. Tighten stop losses under recent swing lows, never widen them to give positions room. Cancel all add-on purchases during euphoric breakouts from extended bases. Set maximum portfolio heat at the 3% total risk across all open positions when distribution days exceed 3 in 2 weeks. Counterintuition alert. The more successful you become in a bull market, the more dangerous your position becomes. Success breeds overconfidence. Overconfidence breeds larger positions, and larger positions breed catastrophic losses when character changes. This cycle operates independently of analytical skill or market knowledge. Even brilliant traders fall victim because success feels like validation of permanent edge rather than temporary alignment with favorable conditions. The confidence trap exploits psychological mechanisms that bypass rational analysis. Extended winning streaks create neural pathways associating current methods with inevitable success. The brain interprets recent results as predictive of future performance, despite logical understanding that markets cycle. This creates dangerous blind spots where obvious risks become invisible because they contradict recent experience. Professional identity requires systematic position sizing that scales inversely with confidence levels. When everything feels perfect and positions feel comfortable, reduce size and tighten stops. When markets feel dangerous and positions feel uncomfortable, you're probably sized correctly for actual risk. This approach violates every instinct developed during bull advances, but it preserves capital for opportunities that bear markets create. Document your current position sizes while reading this. Compare them to sizing from 6 months ago. If they've grown significantly due to success, rather than additional capital, you're entering the confidence trap. The solution isn't complex. Reduce size, tighten stops, increase cash allocation. These actions feel wrong when profits flow, but they're exactly right for capital preservation. The market will pay you to be wrong in a bull market, then collect with compound interest. This captures the essential cruelty of market cycles. Bull markets reward overconfidence, excessive leverage, and sloppy risk management for extended periods. Traders develop habits based on this temporary reward system. When conditions change, the market collects not just current losses but compound interest on every bad habit that bull markets encouraged. But confidence isn't the only trap stalking successful traders near market peaks. There's a subtler warning embedded in the market's internal structure that even experienced professionals miss until the damage is already done. Recognition without execution is worthless. You've identified distribution through heavy volume declines, respected the time element by waiting for proper confirmation, and avoided the confidence trap by reducing position sizes during success. Now you must execute without flinching when signals align, because tops punish sloppy risk management with mathematical precision. This is where knowledge transforms into results or evaporates into regret. The difference between survival and catastrophe lies not in superior analysis but in disciplined execution when emotions run highest and instincts scream loudest. Consider two traders who held identical positions in the same winning stock, up 120% over 18 months of relentless advance. Both possessed equivalent analytical skills and recognized distribution building through declining participation and increased selling volume. Their execution separated profit from devastating loss. Trader A saw a late-stage breakout to new highs and interpreted it as confirmation of another leg higher. He added to his position with conviction, then widened his stop-loss from 8% to 15% below entry to avoid getting shaken out by noise. When the stock broke its 50-day moving average on 2.3 times normal volume, he rationalized giving it room to work rather than honoring his original exit plan. He watched a 22% drawdown destroy 6 months of gains in 8 trading sessions, eventually capitulating at the worst possible moment. Trader B executed through systematic protocol instead of emotional interpretation. When that same late-stage breakout occurred, he sold 1/3 of his position into the strength, banking profits, while the market provided maximum liquidity. He raised stop losses under the most recent swing, low tightening rather than widening his risk parameters as character deteriorated. All future add-on purchases were canceled regardless of how bullish the breakout appeared. When the stock broke its 50-day moving average on heavy volume, he exited remaining shares immediately without debate or hesitation. Then he waited for the inevitable retest of the breakdown level. When that retest failed at a lower high on diminished volume, he initiated a small short position with precisely 0.5% portfolio risk, placing his stop just above the failed retest high. The professional's execution protocol operates through 5 systematic components that remove emotion from critical decisions. First, de-risk into strength by selling 533% of winning positions on late-stage breakouts, or euphoric gap-ups. This contradicts every instinct developed during bull advances, but it banks profits when the market provides maximum liquidity for exits. Amateur traders view strength as confirmation to add. Professionals view strength as opportunity to distribute inventory at favorable prices. Second, tighten stop losses by placing them under pivotal swing lows rather than widening them to avoid noise. Near market tops, what appears as temporary volatility often represents permanent character change. Never move stops wider during late cycle conditions. This single rule prevents more catastrophic losses than any other risk management technique. Your stop loss becomes insurance that costs more when you need it most. Third, size small, using 25 to 50 basis points risk per initial probe when distribution signals appear. Let confirmation through price action earn larger position sizes rather than betting big on analysis alone. Markets can remain irrational longer than accounts can remain solvent, particularly during transition periods when old rules stop working and new rules haven't established themselves clearly. Fourth, reverse methodically by initiating short positions only after heavy volume breaks of key support levels followed by failed retests that establish lower highs. Place initial stops just above that lower high, not above the previous absolute peak. This approach eliminates premature entries while providing clear risk parameters and asymmetric reward potential. Fifth, pyramid correctly by adding to profitable positions only after demonstrable progress through new lows on increasing volume. Maximum 3 additions, each smaller than the previous position to maintain proper risk weighting. Stop adding if volume diminishes or price fails to make meaningful progress within reasonable timeframes. Execution becomes choreography where each move prepares the next and each restraint protects the whole. Your edge isn't prediction. Your edge is procedure under pressure. When distribution days exceed 3 in 2 weeks, reduce position sizes automatically. When climax runs exceed 20% in 20 sessions, cancel all add-on purchases immediately. When good news fails to produce new highs, raise cash allocation to defensive levels. These responses feel mechanical because they are mechanical. Emotion-driven execution produces emotion-driven results. Counterintuition governs successful execution near market tops. Your best trade may be not trading at all. Cash preservation often outperforms heroic attempts to nail exact turning points while others frantically predict precise peaks. Sitting still during emotional extremes requires discipline that separates professionals from amateurs who equate activity with productivity. Cash provides optionality, reduces stress, and prepares you for opportunities that corrections create. The identity contrast becomes stark during execution phases. Amateurs fight trend changes with ego and hope, adding to losing positions and personalizing market movements through emotional filters. They interpret price action as validation or rejection of their intelligence rather than information about supply and demand dynamics. Professionals let the tape lead and follow with disciplined position management, responding to what markets do rather than what they think markets should do. Risk management becomes paramount during execution because transition periods create maximum uncertainty with minimum visibility. Position sizes that felt conservative during bull advances become dangerous during character changes. Stop losses that seem too tight during trending. Markets become essential during reversal processes. The margin for error contracts dramatically when market character shifts from trending to transitional. Professional execution requires accepting small losses to avoid large ones through systematic responses to specific signals. This means honoring stops even when positions feel temporarily oversold, banking partial profits even when trends seem likely to continue, and sizing down even when conviction remains high. These actions feel wrong in the moment but prove correct over time when measured against catastrophic alternatives. In transitions, trade small and think slow. The market will speed up for you. This maxim captures the essential patience required during uncertain periods. Rushing execution during market transitions typically produces inferior results compared to deliberate, systematic responses to confirmed signals. Markets reward those who wait for clarity rather than those who act on ambiguity or emotion. Now comes the moment of truth. The three-signal sequence that marks every bull market's death with mathematical precision, providing the final framework for systematic execution when the inevitable occurs. Every bull market dies following this exact three-signal sequence with mathematical precision that spans decades, markets, and asset classes. Master this pattern, and you'll never be caught off guard again by reversals that destroy unprepared traders. These signals appear in identical order because they reflect unchanging human psychology, interacting with finite capital flows, institutional distribution disguised as retail euphoria, creating the ultimate transfer of wealth from late buyers to early sellers. The sequence operates independently of fundamental analysis or economic conditions because it measures the exhaustion of available buyers through objective price and volume analysis. Signal 1 manifests as the climax run where leaders and indices sprint 20-30% in 10 to 20 sessions after already extended advances. Daily ranges expand dramatically as volatility spikes beyond normal parameters. Volume surges on euphoric news, promising paradigm shifts and permanent prosperity. This represents forced buying institutions chasing benchmarks before quarter end, retail experiencing FOMO at fever pitch, and systematic momentum strategies triggering simultaneously. The acceleration looks bullish to crowds, but signals exhaustion to professionals who understand that vertical moves consume available buyers rather than create sustainable trends. Consider what unfolded in late 1999 when a semiconductor leader ran 28% in exactly 3 weeks after already doubling that year. Each pullback lasted precisely 1 day before buyers emerged with renewed conviction. Then came the tell that separated professionals from amateurs. A gap-up opening on revolutionary earnings guidance reversed completely by midday, closing mid-range on the heaviest volume in months. Professionals recognized this price action as distribution and sold into that strength without emotion. Amateurs interpreted the reversal as temporary profit-taking and doubled down on what they perceived as a dip in an unstoppable trend. Your protocol during climax runs demands selling 25-50% of winning positions into strength and canceling all add-on purchases regardless of how bullish breakouts appear. Bank profits when the market provides maximum liquidity rather than waiting for perfect exits that rarely materialize. Signal 2 appears as character change where the tape breaks key support levels, typically the 50-day or 10-week moving average on above-average volume that cannot be dismissed as noise. Good news fails to ignite rallies despite positive fundamental developments. Former leaders attempt to reclaim previous highs but consistently stall at lower levels, creating a pattern of lower highs that confirms supply overwhelming demand. The psychology shifts from buying dips to selling rallies as confidence erodes systematically. Watch this pattern through specific mechanics. The index drops 2.1% on volume, exceeding recent averages by 80%, representing genuine institutional selling rather than retail panic. The following session brings a rally attempt on lighter volume that fails to reclaim the previous day's opening level. When this bounce stalls below the prior high, you've identified your pivotal point, the level separating bullish from bearish character. Professionals initiate small risk short positions here with stops just above that failed retest level. Amateurs dismiss the breakdown as a bear trap and continue buying, convinced the bull market remains intact despite deteriorating technical evidence. The amateur sees temporary weakness. The professional sees permanent character change. During this phase, raise cash allocation to 70 to 100% of portfolio value. Consider protective hedges through index options, and initiate small short positions only after failed retests confirm the shift. Use position sizes respecting uncertainty, 25 to 50 basis points of portfolio risk per probe, with stops just above lower highs that define failed rallies. Signal 3 completes the sequence through final distribution where breadth narrows dramatically even as major indices attempt to retest previous peaks. Fewer stocks participate in rallies despite headline indices suggesting continued strength. Market internals deteriorate as advancing issues decline and new highs contract, while indices mask weakness through large cap concentration. Leadership concentrates into a shrinking handful of names, while second-tier leaders break down quietly. The last chance rally tops at a demonstrably lower high on volume, failing to match previous advances, completing the distribution process, as professionals finish unloading inventory to desperate late buyers who interpret the rally as confirmation that correction has ended. Following this final distribution comes the air pocket, 8–12% declines compressed into days rather than weeks as selling overwhelms all available bids. Support levels that held for months evaporate in sessions as algorithmic selling amplifies human panic. Those who ignored the three-signal sequence find themselves trapped in positions gapping down through stop levels, creating losses exceeding all risk management parameters. During final distribution, stop arguing with tape action and focus entirely on capital protection, pyramiding short positions only after confirmed progress through new lows on expanding volume. Your complete protocol operates through systematic responses without emotional interpretation. The hidden tell amateurs consistently ignore reveals itself through good news that fails to lift prices despite positive developments. Earnings beats producing selling, favorable economic data triggering declines, and bullish analyst upgrades unable to sustain rallies, all signal sentiment shifting from accumulation to distribution. The tape always speaks before headlines catch up, because price reflects collective actions, while news reflects lagging interpretations. Vertical moves create vulnerable positions. When everyone's a genius, no one's thinking. This three-signal death sequence requires observation, confirmation, and execution, not prediction. The framework provides systematic responses to inevitable developments, rather than requiring perfect timing or superior analysis. Now comes your survival protocol, 4 unbreakable rules that will protect your wealth when this inevitable sequence unfolds. The pattern is mapped, the signals are clear, and the execution framework is defined. Now comes your survival protocol, 4 unbreakable rules that will protect your wealth when the inevitable occurs. These rules have preserved capital through every major market reversal since Livermore's era because they address unchanging human psychology rather than evolving market mechanics. They feel uncomfortable precisely because they require acting against crowd sentiment when the crowd appears to be winning, but that discomfort confirms you're thinking like a professional rather than following the herd toward destruction. Rule 1 demands cutting position sizes as profits accumulate, contradicting every instinct developed during bull market advances. This principle seems backwards because success typically earns the right to bigger bets in most endeavors. But markets operate through inverse logic, where extended success increases rather than decreases systemic risk. Livermore learned this through devastating experience. I made most of my money sitting tight, but I lost most of my money getting too big. When your account grows by 50% through trading profits, reduce individual position sizes by 1/3, rather than maintaining constant percentage risk. After doubling your account, cut position sizes in half, A $100,000 account risking 2% per trade loses $2,000 on wrong decisions. When success grows that account to $500,000, maintaining 2% risk means wrong trades now cost $10,000, 5 times the absolute loss for identical analytical errors. The market pays you to be wrong during bull advances through small losses and frequent wins, then collects with compound interest when character changes and large positions face air pockets. Rule 2 requires tracking sector rotation, like your financial life depends on it, because mathematical reality proves it does. When defensive sectors like utilities, consumer staples, and healthcare begin outperforming growth sectors consistently over 2 to 3 week periods, institutional money is rotating toward safety ahead of anticipated volatility. This rotation precedes rather than follows market declines because professional managers position defensively before retail traders recognize deteriorating conditions. When market leadership narrows from hundreds of stocks, making new highs to dozens, then single digits, the breadth deterioration signals exhaustion of available buyers across the market spectrum. Monitor sector relative strength weekly through simple ratios. Utilities divided by technology, consumer staples divided by consumer discretionary, healthcare divided by semiconductors. Rising ratios over consecutive weeks signal defensive rotation that typically precedes market corrections by 2 to 8 weeks. Reduce equity exposure immediately when defensive rotation becomes apparent. Don't wait for confirmation from financial media, which reports developments after institutional positioning completes. Rule 3 demands raising cash during euphoria phases, even when it feels profoundly wrong. When everyone becomes a genius through buying any stock and watching it rise. When risk disappears from conversation and volatility becomes extinct memory. That's your signal to become increasingly conservative rather than increasingly aggressive. Build your war chest during these periods for opportunities that crashes create rather than chasing the final moves of exhausted trends. Cash allocation should increase from normal 10-20% levels to 50-80% when euphoria indicators flash simultaneously. Margin debt reaching new highs. IPO volume surging. Retail participation spiking. And financial media celebrating new paradigms. These conditions create maximum vulnerability because they represent maximum complacency. Your competitive advantage lies in recognizing that when everyone feels safe, no one is actually safe. Cash is not merely a position. It is ammunition for deploying when fear grips the market and opportunities emerge from wreckage. Rule 4 prohibits abandoning stop losses regardless of how long the bull market has run or how many consecutive winners you've achieved. This rule is non-negotiable. The longer you've been right, the more dangerous it becomes to relax discipline, because extended success breeds overconfidence that leads to position size creep and stop-loss abandonment. Your stop-loss functions as insurance, and you need insurance most when you think you need it least. During late cycle conditions, tighten stops under recent swing lows rather than widening them to avoid noise. What appears as temporary volatility near market tops often represents permanent character change that destroys capital through false security. Set maximum stop-loss levels at 7 to 10% below entry points, and honor them without exception, debate, or rationalization. Widening a stop-loss to give a position room is a psychological trick your brain plays to avoid realizing a small loss, almost always resulting in much larger, more damaging losses. These 4 rules feel uncomfortable because they require acting against crowd sentiment when the crowd appears to be winning. But that psychological discomfort confirms you're thinking like a professional rather than following amateur instincts toward destruction. Professional thinking contradicts crowd thinking at inflection points, because crowds optimize for comfort, while professionals optimize for survival and profit. Amateurs seek validation from the herd. Professionals seek validation from the tape. Your final execution checklist operates through systematic components that remove emotion from critical decisions. Cut losses fast using maximum 7 to 10%. Stops without exception or debate. Size positions at 1 to 2% risk during late cycle conditions, rather than normal 2 to 3% levels. Wait for confirmation before reversing positions. Patience pays compound interest through higher probability entries and tighter risk parameters. Own your process rather than your positions, meaning systematic responses to signals matter more than being right about individual trades or market direction. Mathematical reality provides sobering perspective on why capital preservation trumps profit maximization near market tops. A 30% portfolio drawdown requires a 43% gain just to reach break-even, nearly half again as much upside as the downside that created the hole. A 50% drawdown demands 100% gains for recovery. These mathematical realities explain why professionals focus on avoiding large losses rather than capturing every possible gain. Don't donate your capital to the market's inevitable cycles through overconfidence or relaxed discipline. When survival should take priority over growth, the next bull market crash is inevitable. The only questions are timing and severity, not whether it will occur. But now you possess Livermore's complete blueprint for not just surviving but positioning yourself to profit when others panic, through systematic preparation rather than emotional reaction. If this framework opened your eyes to bull market endings, the next lesson reveals how to identify the specific recovery stocks that outperform by 300 to 500% in the aftermath when prepared capital meets oversold opportunities.